Japanese candlesticks.
Trading patterns have existed since the 1700s. But here's something wild. The same candlestick charts Japanese rice merchants use to track grain prices are driving billion-dollar decisions on Wall Street today.
That's fascinating. How did ancient rice trading techniques become so crucial to modern markets?
Well, it all comes down to human psychology. These Japanese merchants realized that emotions like fear and greed leave distinct patterns in price movements. And those same emotional patterns show up whether you're trading rice in 1750 or Tesla stock in 2024.
So you're telling me these patterns are basically a visual representation of market psychology?
Exactly right. Think of each candlestick as telling a story. The body shows where prices opened and closed, while those little lines we call wicks reveal the highest and lowest points during trading. It's like watching a miniature drama unfold.
That makes so much more sense than just seeing them as random shapes on a chart. What are some of the most important patterns traders look for?
Let me start with my favorite, the Marubozu. Picture a candlestick with absolutely no wicks, just a pure body. When it's green or bullish, it means buyers were so dominant that the price never dipped lower during that entire period. It's like watching a one-sided boxing match.
Oh, wow. So that would be a pretty strong signal then?
Definitely, especially when you find it in the right context. For instance, if you spot a bullish Marubozu right after a downtrend, it's often like a neon sign saying, hey, this downward momentum might be about to reverse.
What about when markets are more uncertain? Are there patterns that show that kind of hesitation?
That's where the fascinating doji patterns come in. Imagine a candlestick that looks like a cross, where the opening and closing prices are virtually identical. The Japanese got really poetic with these, naming variations like the dragonfly doji and the gravestone doji.
Those names are so evocative. Do they actually look like what they're named after?
They really do. A dragonfly doji looks like a T, showing that sellers tried to push the price down, but buyers fought back to close at the high. The gravestone is the opposite, an upside down T, where buyers pushed up but ultimately lost to selling pressure.
How do experienced traders actually use these in real time? It seems like there would be a lot to keep track of.
Well, here's where it gets interesting. Professional traders never rely on just one pattern. They're more like detectives building a case. Maybe they spot a bullish engulfing pattern. That's where a large green candle completely covers the previous red one. But they'll also look at trading volume, support levels, and other technical indicators.
That makes sense. You wouldn't want to make big financial decisions based on a single signal.
Right, and that's actually one of the biggest mistakes new traders make. They'll see something like a spinning top pattern, which has a small body with long wicks on both sides, and immediately think they should trade on it.
What should they be doing instead?
Think of it like weather forecasting. You wouldn't predict tomorrow's weather just by looking at the current temperature. You'd want to see wind patterns, pressure systems, and historical data. Same with trading. These patterns are just one tool in a much larger analytical toolkit.
That's a really helpful analogy. What are some other common patterns traders should know about?
Let's talk about the long day patterns. These are like the foundation of candlestick analysis. A long day bullish candle has a tall green body with short wicks, showing strong buying pressure throughout the trading period.
And I'm guessing a long day bearish would be the same thing but red?
Exactly. But here's what's fascinating. These patterns often show up in clusters that tell an even bigger story. For instance, you might see a series of long day bearish candles, followed by a doji, suggesting the downward momentum might be running out of steam.
How reliable are these patterns in predicting market moves?
That's where context becomes crucial. A pattern that might signal a strong reversal at a major support level could mean something completely different in the middle of a trending market. It's all about understanding the bigger picture.
So it's really more of an art than a pure science?
You've hit on something important there. While these patterns have been statistically studied and backtested, there's definitely an art to interpreting them in real-time market conditions. It's about combining technical analysis with market psychology and risk management.
What would you say to someone just starting to learn about candlestick patterns?
Start with the basics. Learn to recognize the fundamental patterns like Maribozu, Doji, and engulfing patterns. Practice identifying them on historical charts before risking any real money. And most importantly, understand that these patterns are suggesting possibilities, not guarantees.
That's really helpful advice for beginners. Any final thoughts on where candlestick analysis is heading in the future?
You know what's fascinating? Even with all our advanced technology and algorithmic trading, these centuries old patterns still work because they're based on something that hasn't changed: human nature. As long as markets are driven by human emotions, candlestick patterns will remain relevant.
That's quite profound when you think about it, connecting us directly to those Japanese rice merchants from hundreds of years ago.
Exactly. It's a reminder that while markets evolve, the fundamental psychology of trading remains remarkably consistent. Whether you're trading rice in 18th century Japan or cryptocurrencies in 2024, the patterns of human behavior leave their mark on the charts.
Types of trading charts.
Trading charts seem simple on the surface, just lines and bars tracking price movements. But what most people don't realize is that these visual tools have sparked some of the biggest market revolutions in history, completely transforming how we understand market psychology.
That's such an interesting perspective. The way these charts have evolved from simple rice trading in feudal Japan to today's sophisticated digital platforms. What first drew you to exploring the different types?
Well, you know how they say a picture's worth 1,000 words? In trading, the right chart can be worth 1,000 trades. I was analyzing some market data recently and noticed how different chart types revealed completely different patterns in the same price action.
Hmm, that makes me think about how candlestick patterns have this almost universal language among traders. The psychology behind each pattern is fascinating.
Exactly right. And here's something that blew my mind. When you look at a traditional time-based candlestick chart versus something like a tick chart, you're essentially seeing two different versions of market reality. Like, take USD, for example. On a 1 minute chart, you might see chaos, but switch to a 100 tick chart, and suddenly there's this beautiful trend emerging.
Oh, wow. So it's almost like having multiple lenses to view the same market movement. How does that work with actual trading decisions?
So check this out. Let's say you're trading the DAX index. On a standard 4-hour chart, you might see what looks like random noise. But switch to a 100 range chart, and boom, suddenly you can see these clear trending moves because you've filtered out all the time-based noise.
That's really fascinating how eliminating the time factor can reveal hidden patterns. Tell me more about these non time based charts.
Well, think about it like this. In a tick chart, each new bar forms after a specific number of transactions, regardless of time. So during high volatility, you might get several bars in a minute. But during quiet periods, it could take an hour for a single bar to form. It's like having a chart that breathes with the market.
Now, that's a perspective I hadn't considered before. The chart actually adapting to market activity rather than arbitrary time intervals.
And here's where it gets even more interesting. Renko charts take this concept to another level. You know how they got their name? From the Japanese word renga, meaning brick. Each brick only appears when the price moves a predetermined amount, like 5 pips. It's literally building a wall of price movement brick by brick.
That's such a clever way to filter out market noise. I imagine it must make trend identification much clearer.
Oh man, you should see how clean the trends look. But here's the real kicker. When you combine different chart types, like using Heikin Ashi for trend confirmation, while watching traditional candlesticks for entry signals, it's like having multiple expert opinions on your trade.
Market environment. Ranges versus trends.
Markets are like weather patterns. Some days you get calm seas, other days you're riding massive waves. And today we're exploring why recognizing these patterns early can mean the difference between sailing smoothly and capsizing.
That's such an interesting way to look at it. How did you first start noticing these distinct market patterns?
Well, it really clicked for me when I started seeing how markets have two main personalities. They're either trending like a determined hiker going up or down a mountain, or they're ranging like a pendulum swinging back and forth between 2 points.
Could you break down what exactly makes something a trend versus a range? I feel like sometimes it's not always clear cut.
Picture a staircase. In an uptrend, each step is higher than the last, creating what traders call higher highs and higher lows. It's like the market is climbing up, taking regular breathers at each new level.
Hmm, that makes sense. So, what are these swing highs and lows I keep hearing about?
Think of them as the market's footprints. You need three candlesticks to form them, like three friends walking together, where the middle one either bends down lower than the others for a swing low or reaches up higher for a swing high.
Oh, that's actually much clearer than I expected. But surely it can't always be that simple in real trading?
You're absolutely right. The real market is more like a jazz improvisation than a classical piece. Sometimes what looks like a clear pattern breaks, but the overall trend continues anyway. It's one of those things that makes trading both fascinating and frustrating.
So, what tools do traders use to help navigate these patterns?
Well, for trending markets, traders often rely on indicators like moving averages, Ichimoku cloud, and MACD. Think of them as your GPS system for trading. They help confirm the direction and strength of the trend.
And what about when markets are ranging? I imagine you need a different set of tools entirely.
Exactly right. In ranging markets, we're looking at tools like Bollinger Bands, RSI, or stochastic indicators. These help us identify when the market has stretched too far in either direction and might snap back like a rubber band.
That's fascinating. But how do you know which environment you're in? It seems like that would be crucial to get right.
That's where the art of trading comes in. You're looking for specific clues. In trends, you want to see those consistent higher highs and higher lows we talked about. In ranges, you'll notice price repeatedly bouncing between clear support and resistance levels.
I can see how getting this wrong could be costly. What happens if you use the wrong strategy?
Oh man, it can be like bringing a knife to a gunfight. If you try to trade a range strategy in a strong trend, you'll keep trying to pick tops and bottoms, only to watch the market continue moving against you. It's a quick way to empty your trading account.
That sounds painful. So, what's the key to avoiding these mistakes?
The secret is adaptability. Markets spend about 70% of their time ranging, but those 30% trending periods often offer the biggest profit opportunities. You need to be like a chameleon, changing your approach based on what the market is giving you.
That's really interesting. I never knew markets spent so much time ranging. How do successful traders handle these transitions?
They develop what I call a market environment checklist. First, they look at the bigger picture. Are we making those higher highs and lows, or are we bouncing between levels? Then they confirm with their technical indicators, and finally, they adjust their strategy accordingly.
What about risk management? Does that change between environments too?
Absolutely. In trending markets, you might use wider stops and let your profits run. In ranging markets, you're usually looking at tighter stops and more defined profit targets. It's like adjusting your driving style between highway and city traffic.
That makes a lot of sense. Any final wisdom for traders trying to master this?
The biggest thing is to remember that the market environment is always changing. Don't fall in love with one approach. Be like water, adapt to whatever container you're in, and most importantly, always have a clear plan for what you'll do if you're wrong.
That's really powerful advice. It seems like success in trading is as much about adaptability as it is about analysis.
That's exactly right. And remember, the goal isn't to predict the future, it's to recognize what's happening now and adjust accordingly. It's like being a good dance partner. You need to feel the rhythm and move with it, not fight against it.
Well, this has certainly changed how I'll look at markets from now on.
That's what makes trading such an endless journey of learning. Every day brings new patterns, new challenges, and new opportunities to apply these principles in different ways.
Support and resistance.
Trading support and resistance levels seem straightforward on paper, but here's the mind-bending truth. The more times price hits these levels, the weaker they actually become. Let's explore why this counterintuitive concept is crucial for traders to understand.
You know what's fascinating about that? It completely challenges what most beginner traders are taught. I remember when I first started, everyone said multiple touches made levels stronger.
Well, let's break down why that conventional wisdom is wrong. Think of it like a dam holding back water. Every time price touches a level, it's like water pressure testing the structure. Those pending orders sitting there, they're getting eaten away, one touch at a time.
That's such a vivid way to explain it. So, how does this play out in real market conditions?
Picture this. When price approaches a support level for the fourth or fifth time, most traders think, oh, this level is rock solid now. But what they're missing is that each previous touch has cleared out the buy order sitting there. It's like removing bricks from that dam, one by one.
Hmm, that really makes me think about all those trading books that got this wrong. But let's talk about the different types of support and resistance. There's more to this than just horizontal levels, right?
Exactly right. We've got three main categories to consider: horizontal, diagonal, and dynamic. Each one works differently in the market, and here's what's really interesting. The higher the time frame you're looking at, the more significant these levels become.
That makes sense when you think about it. A support level on a weekly chart has way more weight than one on a 5-minute chart, doesn't it?
Precisely. Think about it this way. Weekly levels are like major highways on a map, while 5-minute levels are more like local streets. Big institutional traders are watching those highways, and that's where the serious money flows.
So, how do you recommend traders approach these different time frames?
Well, I always start with the weekly chart, then work down to daily, and finally to the shorter time frames. It's like zooming in on Google Maps. You want to see the big picture first. And here's something fascinating about round numbers. They act as psychological support and resistance levels all on their own.
That's right. Prices tend to pause or reverse at levels like 100, 150, 200. It's amazing how human psychology affects market movements in such predictable ways.
And speaking of psychology, let's talk about diagonal support and resistance. Those trend lines that everyone loves to draw. They're actually more subjective than most traders realize, which can be both a blessing and a curse.
You know what I've noticed? Different traders often draw their trend lines slightly differently, which creates these zones of support and resistance rather than exact lines.
That's a crucial observation. These aren't laser precise levels, they're more like zones where buying and selling pressure tends to cluster. And this brings us to dynamic support and resistance, which is fascinating because it's constantly moving with price.
Like moving averages, right? The 50-day, 100-day, and 200-day moving averages that seem to have almost magical properties in the market?
Exactly. But it's not magic, it's mass psychology at work. When enough traders watch these levels, they become self fulfilling prophecies. The real power comes when you see multiple types of support or resistance converging at the same price zone.
That reminds me. What about those times when support becomes resistance or vice versa? That's always fascinated me.
That's called role reversal, and it's one of the most reliable patterns in technical analysis. When a strong support level finally breaks, all those trapped buyers become potential sellers, creating resistance. It's like a crowd of people suddenly changing direction.
The market really is just one big psychological experiment, isn't it?
It absolutely is. And that's why understanding these concepts is so crucial. Let's talk about how to actually trade these levels effectively. First rule: never put your stops too close to these levels.
Because of those stop hunts you mentioned earlier? Where price briefly pushes through a level just to trigger stops.
Exactly. Big players know where retail traders place their stops, and they'll often push price just far enough to trigger them before reversing. It's like a game of poker. You need to think about what the other players are thinking.
That's why understanding market structure is so important, right? You need to see the bigger picture.
Precisely. And here's something most traders miss. Volume analysis at these levels can tell you a lot about whether a level is likely to hold or break. High volume at a level usually means more significant support or resistance.
Speaking of volume, what about those volume-weighted average price levels? They seem to act as dynamic support and resistance too.
They do, and they're especially important for day traders and institutional traders. But here's the key. No matter what type of support or resistance you're trading, you need to understand that these levels are probabilistic, not deterministic.
That's such an important distinction. These aren't guaranteed bounce points. They're areas where the probability of a reversal is higher.
And that brings us to risk management. The best traders don't just look for support and resistance levels. They look for confluence of multiple factors. Maybe a horizontal level lines up with a moving average and a round number.
Those triple confluence setups can be powerful, but you still need to manage your position size and risk, right?
Absolutely critical. Even the strongest looking levels can break, which is why position sizing and stop placement are just as important as identifying the levels themselves. Remember, we're playing a probability game here.
And that's really the key takeaway, isn't it? These levels work because enough people believe in them and act on them, but they're not guaranteed.
Exactly right. Support and resistance trading is about understanding market psychology, managing risk, and being prepared for either outcome, the level holding or breaking. Success comes from playing the probabilities while protecting your capital.
Supply and demand trading.
Supply and demand, it shapes literally everything in our economy. But what most traders get completely wrong about it could be costing them thousands in missed opportunities.
That's such an eye-opening way to think about it. You know, I was just reading about how institutional traders use these principles in ways most people never consider.
Let me share something fascinating about market behavior that completely changed my perspective. The common belief is that prices move because there are more buyers than sellers. But here's the mind-blowing truth. That's mathematically impossible.
Hmm, now that's interesting. You mean because every single trade needs both a buyer and a seller?
Exactly right. Let me break this down with a real-world example. Picture a stock trading at $100. Above that price, we've got 5 sell orders at $101, another 10 at $102. It's like a ladder of prices waiting to be climbed.
Oh, and I'm guessing below that $100 mark, we've got the mirror image with buy orders?
You've got it. And here's where it gets really interesting. Price movement isn't about quantity at all. It's about what we call aggressiveness in the market. When buyers are willing to climb that ladder of prices, that's what creates upward momentum.
That makes me think about those limited edition sneaker releases where people are willing to pay crazy prices just to get their hands on them.
Perfect analogy. And speaking of limited editions, let's look at how Apple masterfully uses supply and demand. When they release a special edition iPhone with limited quantity, what happens?
Well, we've all seen those lines around the block and the secondary market prices going through the roof.
Right, and here's the fascinating flip side. When they release a regular model with unlimited supply and it gets mediocre reviews, suddenly we see carrier deals, discounts, and price drops until they find the right demand level.
So, how does this translate to what we see in financial markets? I mean, we're not exactly lining up outside the New York Stock Exchange.
Here's the key insight. Institutional traders, the ones who really move markets, they're like the Apple of the trading world. They can't just dump their massive orders whenever they want. They need what we call liquidity pockets.
You mean like those zones where there's enough trading volume to handle their large positions?
Precisely. And this creates what we call supply and demand zones, areas where these big players leave their footprints. Think of it like seeing elephant tracks in the sand. You know something big was there.
That's fascinating. So these zones become like historical markers of significant trading activity?
Exactly. And here's something most retail traders miss. These zones aren't random. They're places where institutional traders couldn't complete all their intended trades. It's like they've got unfinished business there.
Chart patterns. Trading.
Chart patterns in trading have shaped market movements for over a century. But here's something wild. Studies show these patterns are actually becoming more reliable in the age of algorithmic trading, not less.
That's fascinating. I would have thought computers would make these traditional patterns obsolete.
Well, it's actually the opposite. Algorithms are often programmed to recognize and trade these same patterns, creating a self-fulfilling prophecy. Let's dive into these fascinating formations, starting with the head and shoulders pattern. which has an astounding 83% success rate when properly identified.
The psychology behind that pattern is so interesting. It's like watching market sentiment shift in real time.
Exactly right. Think of it like this. The first shoulder shows optimism, the head shows peak euphoria, and that final shoulder, that's when reality sets in. Studies from the Journal of Technical Analysis show this pattern has predicted major market reversals in 8 out of 10 cases over the past decade.
Hmm. And what about its inverse? The pattern that forms at market bottoms?
The inverse head and shoulders is equally powerful, and here's something most people don't know. It typically forms 30% faster than its topside counterpart. It's like watching panic selling exhaust itself in 3 distinct waves.
That timing difference really shows how fear and greed operate differently in markets, doesn't it?
You know what's even more interesting? Let's talk about the cup and handle pattern. It was first identified by William O'Neill in the 1980s, and his research showed that stocks forming this pattern went on to gain an average of 47% after breaking out.
Well, that's incredible. But I imagine timing must be crucial with these patterns.
Absolutely right. And speaking of timing, triangle patterns are fascinating because they typically resolve within 75% of their formation. So, if you see a triangle forming over 20 days, you can expect a breakout around day 15.
The mathematical precision of these patterns is remarkable. How do professional traders incorporate them into their strategy?
Here's where it gets interesting. A survey of institutional traders showed that 92% use pattern recognition, but only 31% trade patterns in isolation. Most combine them with volume analysis and momentum indicators. And speaking of confirmation, let's talk about wedge patterns. Recent studies show that falling wedges in bullish markets have a success rate of nearly 90% when accompanied by positive divergence in the RSI indicator.
Oh, wow. That's significantly higher than I would have expected for any technical pattern.
You know what's even more fascinating? Double tops and bottoms have shown increased reliability in cryptocurrency markets. They're actually 12% more accurate there than in traditional stock markets.
That's surprising? Why do you think that is?
Well, it likely relates to the higher retail participation in crypto markets. These traders tend to react more strongly to visual patterns. Speaking of which, flag patterns in crypto markets typically resolve 40% faster than in traditional markets.
The speed of pattern formation really highlights how market psychology operates at different paces across various assets.
Here's something that might surprise you. A study of over 10,000 flag patterns showed that bull flags in strong trends have a 68% success rate, while bear flags in downtrends have a 72% success rate.
That slight difference in success rates is intriguing. It suggests markets might fall more predictably than they rise.
Fibonacci trading.
The golden ratio. It's everywhere in nature, from sunflower patterns to galaxy spirals. But here's something wild. This same mathematical sequence is helping Wall Street traders make millions in the market. And it's not just coincidence.
That's fascinating how these ancient mathematical patterns keep showing up in modern finance. The way these numbers translate into actual trading decisions is remarkable.
Let me break this down. We're talking about a sequence where each number is the sum of the two before it. 0, 1, 1, 2, 3, 5, 8, 13, and so on. But here's where it gets interesting. When you divide these numbers, you get these specific ratios that traders swear by.
And these aren't just random numbers, right? We're looking at specific percentages: 23.6%, 38.2%, 50%, 61.8%, and 100%. Though, interestingly, that 50% level isn't technically a Fibonacci number.
Exactly right. And here's what's really mind-blowing. These levels work not because of some mystical mathematical power, but because so many traders are watching them. It's like a self-fulfilling prophecy playing out in real time on Wall Street.
So it's really more about math psychology than pure mathematics. How do traders actually use these levels in practice?
Well, imagine you're watching a stock that's just made a big move up. Traders will use these Fibonacci levels to predict where the price might pull back to before continuing higher. The 61.8% level, known as the golden ratio, is particularly important. I've seen countless times where major market reversals happened right at this level.
That's remarkable. And I understand there's also something called Fibonacci extensions for predicting future price targets.
Oh man, let me tell you about what happened during the 2020 market crash. When the NASDAQ was making those wild moves, traders using Fibonacci extensions were able to project potential targets in completely uncharted territory. It was like having a roadmap in unexplored territory.
The way you describe it makes me think of ancient mariners using the stars to navigate unknown waters. How accurate are these predictions usually?
Well, here's the thing. They're not crystal balls. But what's fascinating is how often they work. During the post-COVID recovery, major indices repeatedly found support and resistance at these levels. And with the rise of algorithmic trading, these patterns have become even more relevant.
Hmm, that's interesting. You'd think computerized trading would make these traditional tools obsolete.
You'd think so, right? But here's the twist. Many of these algorithms are actually programmed to respect these same levels. It's created this fascinating feedback loop where both human and machine traders are watching the same numbers.
That really challenges conventional wisdom about modern markets. What's your take on how this might evolve in the future?
Let me share something that's been happening recently. We're seeing a fusion of traditional technical analysis with artificial intelligence. Some trading firms are using machine learning to identify which Fibonacci levels are most likely to be significant under specific market conditions.
The way you're explaining this makes it sound like we're witnessing the evolution of technical analysis in real time.
Exactly. And here's what I consider the three pillars of using these tools effectively. First, always use them with other forms of analysis, never alone. Second, treat them as zones rather than exact lines. And third, this is crucial. Always have a solid risk management strategy.
Those principles really emphasize the importance of a balanced approach. Any final thoughts on incorporating these tools into a broader trading strategy?
Think of it like conducting an orchestra. Fibonacci tools are just one instrument. They can make beautiful music, but only when playing in harmony with everything else. The key is understanding that while these patterns can be remarkably accurate, they're not infallible. Success comes from combining them with proper risk management and a comprehensive trading plan.
That's such a perfect analogy to wrap up with. These ancient mathematical patterns finding their place in modern trading, but only as part of a larger symphony.
And remember, whether you're using Fibonacci levels or any other technical tool, the market will always surprise us. The real skill isn't in predicting the future, it's in managing risk and being prepared for whatever the market throws our way.
Technical indicators.
You know what blows my mind? Over 80% of day traders rely on technical indicators to make decisions, yet studies show only about 1% of them consistently make money. Today, we're diving into why these tools are both loved and feared on Wall Street.
That's such a fascinating disconnect. It's like having a map but still getting lost. Maybe we're reading these indicators all wrong?
Well, let's start with probably the most misunderstood indicator, the MACD. What's interesting is that it was developed in the late 1970s, and despite all our technological advances, it remains one of the most reliable tools we have.
You know what I find intriguing about MACD? It's essentially measuring momentum, but in a way that most people don't realize. It's not just about whether the market is going up or down.
Exactly right. And here's something that might surprise people. Professional traders often use MACD not for its traditional signals, but for what's called divergence. It's like having an early warning system that spots when something in the market doesn't quite add up.
Hmm. That reminds me of how institutional traders use RSI, the Relative Strength Index. They're not just looking at overbought and oversold conditions like most retail traders.
Oh man, the RSI misconceptions could fill an entire episode. You know what's fascinating? During the 2017 crypto bull run, Bitcoin stayed overbought, according to RSI, for nearly 3 months straight. Anyone who sold just because of high RSI readings missed out on about 300% gains.
That's exactly why context matters so much with these indicators. Speaking of which, let's talk about the ADX, Average Directional Index. This one's particularly interesting because it doesn't predict direction at all.
Right. And what's really cool about ADX is how it can help traders avoid one of the biggest mistakes in trading, forcing trades in choppy markets. You know, studies show that markets are actually in a true trend only about 30% of the time.
Well, that explains why so many trend following strategies struggle. But let's talk about something more complex, the Ichimoku cloud. I've always wondered why this indicator seems to work better in some markets than others.
That's because, and this is fascinating, the Ichimoku cloud was originally designed for the Japanese rice markets, where trading patterns were very different from what we see in modern financial markets. But here's the thing, it still works remarkably well for longer term trends.
So, if we're looking at longer term trends, we should probably discuss on balance volume OBV. I mean, it's been around since the 1960s for a reason, right?
Oh man, OBV is like the secret weapon of institutional traders. You know what's wild? During the 2008 financial crisis, OBV actually started declining 3 months before the major market crash. It was literally showing the smart money leaving the market.
That's incredible. It's like having a financial early warning system. But how does it compare to something like the stochastic oscillator?
Well, here's something most people don't realize about stochastic. It was actually developed by a futures trader who noticed that prices tend to close near their daily highs during uptrends. Sounds simple, right? But this observation led to one of the most widely used indicators in modern trading.
The simplicity of some of these tools is really remarkable. Like the moving average crossover, it's basically just two lines crossing, but it's captured some of the biggest trends in market history.
Speaking of which, did you know that the famous golden cross of the 50 and 200-day moving averages has predicted every major bull market since 1950? Though, and this is crucial, it's also given plenty of false signals.
That reminds me of how traders use VWAP, volume weighted average price. The way institutional traders use it is completely different from retail traders.
Oh yeah, VWAP is fascinating because it's one of the few indicators that actually matters to big institutional traders. Fun fact, many institutional traders are actually required by law to execute their trades at or better than VWAP to prove they're getting the best prices for their clients.
That's something most retail traders probably don't realize. And what about Bollinger Bands? They seem deceptively simple.
You know what's interesting about Bollinger Bands? They adapt to market volatility automatically. During the March 2020 market crash, the bands expanded to their widest level since 2008, giving traders a clear signal that something extraordinary was happening.
Looking at all these indicators, what's your take on why so many traders still struggle despite having all these tools?
That's really the million-dollar question, isn't it? The data shows that most traders are actually using these indicators correctly from a technical standpoint. The problem is psychological. They're looking for certainty in a probabilistic game. It's like having a perfect weather forecast, but still getting caught in the rain because you didn't bring an umbrella.
So, what you're saying is these indicators are more like probability tools than prediction tools?
Exactly. And here's the kicker. The most successful traders I know use these indicators not to tell them what to do, but to tell them what not to do. They're using them as risk management tools rather than crystal balls.
Divergence trading.
Trading is often compared to gambling. But what if the secret to consistent profits was hidden in plain sight? Today, we're exploring how divergence trading helps spot market reversals before they happen, giving traders a legitimate edge that most people completely miss.
You know what fascinates me about this topic? It takes something that seems purely mathematical and turns it into an almost artistic form of pattern recognition.
That's exactly right. Think of it like being a detective in the financial markets. While most traders are focused on what the price is doing right now, divergence trading lets us spot subtle clues about what might happen next.
Could you break down exactly how these clues work? I imagine many people find this concept a bit mysterious.
Well, here's the fascinating part. It's all about spotting disconnects between price and momentum. When price makes new highs but technical indicators show weakening momentum. It's like watching an athlete who's still running but starting to fatigue. The finish line might be closer than it appears.
That's such a clever analogy. So we're essentially looking for moments when the market is telling two different stories?
Precisely. And here's where it gets really interesting. Studies have shown that roughly 65% of major market reversals are preceded by some form of divergence. But, and this is crucial, not all divergences lead to reversals. It's like having a good hand in poker. It improves your odds, but doesn't guarantee success.
Hmm. That brings up an important point about reliability. How do successful traders separate the meaningful signals from the noise?
Let me share something that took me years to understand. Context is everything. The most reliable divergences typically appear after extended trends, especially when they show up on multiple time frames. Think of it like weather forecasting. You don't just look at one measurement, you need multiple confirming factors.
That makes so much sense. Could you walk us through the different types of divergence? I know there's regular and hidden divergence.
Well, regular divergence is like spotting cracks in a foundation. It suggests the current trend might be weakening. For example, if price makes higher highs, but RSI makes lower highs, that's bearish regular divergence. Hidden divergence, on the other hand, is more like finding support for an existing trend.
You know what I find particularly intriguing? The psychological aspect of all this. It's almost like reading the collective mind of the market.
That's such an important observation. Divergence often reveals the psychology of smart money before it becomes obvious to everyone else. When institutional traders start taking profits or accumulating positions, it shows up in these subtle indicator patterns before it affects price.
So, how do you recommend traders incorporate this knowledge into their strategy?
Here's my three-step approach. First, always start with the higher time frames. Daily and weekly charts show the most reliable divergences. Second, look for confluence with other technical factors, like support resistance levels. Third, and this is crucial, manage your risk. Never risk more than 1% of your account on any single divergence trade.
Speaking of risk management, what about specific markets? Do these principles apply differently across various assets?
That's where things get really interesting. In Forex markets, divergence tends to be more reliable due to the institutional nature of trading. Crypto markets, being more volatile, often show false divergences. You need to be much more selective. Stock markets require additional consideration of sector trends and broader market conditions.
You mentioned earlier about combining divergence with other indicators. Could you elaborate on your favorite combinations?
Well, volume is my favorite confirming indicator. When you see divergence with corresponding volume patterns, the signal becomes much stronger. For instance, if you have bearish divergence with declining volume on rallies, that's a powerful combination. I also love using Fibonacci retracement levels as additional confirmation points.
Those are really practical insights. What about some common mistakes you've seen traders make?
The biggest mistake is treating divergence as a standalone signal. Remember, markets are complex systems. No single indicator tells the whole story. Another common error is not being patient enough to wait for confirmation. It's better to miss some opportunities than to jump in too early.
This has been incredibly enlightening. Any final thoughts for traders looking to master divergence trading?
Let me leave everyone with this. Divergence trading isn't about finding perfect entries and exits. It's about identifying high probability setups where risk and reward are in your favor. Start small, be patient, and remember that protecting your capital is more important than catching every move. The best traders I know use divergence as part of a complete strategy, not as a magic formula.
That's such valuable perspective. It's about building a complete trading approach rather than looking for shortcuts.
Exactly right. And you know what? The beauty of divergence trading is that it forces you to develop patience and discipline, two qualities that separate successful traders from the rest. It's not about being right all the time. It's about having an edge when you do trade.
How to spot breakouts and fakeouts.
Trading breakouts in the market is a lot like trying to predict when a dam will burst. 90% of traders get swept away by the flood, while the patient ones know exactly when to act. Today, we're exploring why timing might matter more than technique.
That's such a powerful analogy, and it really captures how destructive poor timing can be for traders who rush into breakouts without proper analysis.
You know what's fascinating about breakout trading? It's one of the most widely used strategies, yet studies show that nearly 70% of breakout trades fail due to false signals and premature entries.
Hmm. That statistic really puts things in perspective. Let's dive into why these failures happen and how traders can avoid becoming part of that statistic.
Well, it all comes down to understanding volatility patterns. When we look at market data, periods of low volatility typically precede major breakouts. It's like the calm before the storm.
Oh, right. And that's where technical indicators like Bollinger Bands come into play, measuring these volatility patterns to help predict potential breakouts.
Exactly, and here's something most traders don't realize. The most reliable breakouts often occur when volatility has contracted to the lowest 20th percentile of its historical range.
That's fascinating. So, how do successful traders use this information to their advantage?
Well, instead of chasing every potential breakout, they wait for specific conditions to align. Think about it like this. You've got your volatility indicators showing compression, declining volume, and clear support or resistance levels all coming together.
You know what makes this even more interesting? The psychological aspect of these trades. So many traders get caught up in FOMO and jump in too early.
That's right, and let me share something crucial about market psychology. Large institutional traders often use these emotional responses to their advantage. They know exactly where retail traders place their stops.
Well, that explains why we see so many false breakouts just before the real move happens. It's almost like a deliberate shakeout.
Precisely, and here's the data to back it up. Research shows that roughly 65% of false breakouts occur within the first hour of breaking a significant level. That's why waiting for confirmation is so critical.
So, if we're looking at practical application, what's the most effective way to confirm a genuine breakout?
The key lies in volume analysis, combined with price action. A genuine breakout typically shows volume at least 50% above the 20-day average, along with strong closing prices above the breakout level.
That makes so much sense, and it ties back to what you were saying about institutional traders. They can't hide their footprints when they're really committed to a move.
You know what's really interesting? Studies of successful breakout traders show they typically only take about 30% of the breakouts they identify. It's all about quality over quantity.
That's quite different from what most trading courses teach about being active in the market. How long did it take you to develop this more patient approach?
Through years of observation, I've found that waiting for at least 3 confirmatory candles after a breakout increases success rates from around 30% to nearly 70%. The key is having a systematic approach.
Let's talk about risk management because that seems crucial in this type of trading. How do you protect yourself when you do decide to take a trade?
Well, here's a strategy that's proven effective. Instead of placing stops at obvious levels, use volatility-based stops at 2.5 times the average true range. This approach has shown to avoid about 60% of false breakout traps.
That's really interesting. It's like you're using the market's own rhythm to protect yourself.
Exactly, and here's another crucial point. Position sizing should be inversely proportional to volatility. When volatility is higher, we take smaller positions to maintain consistent risk levels.
Well, that brings up an important question about market conditions. How do you adapt this strategy to different market environments?
The data shows that breakout success rates vary significantly by market condition. In trending markets, breakouts work about 65% of the time, while in ranging markets, that success rate drops to around 35%.
Those numbers really highlight the importance of understanding market context before taking any trades.
And speaking of context, let me share something surprising. The most successful breakout traders actually spend more time analyzing failed breakouts than successful ones. It's where the real learning happens.
That's such a valuable insight about the learning process. What final advice would you give to traders looking to improve their breakout trading?
Well, the most important thing is to develop a systematic approach based on data, not emotions. Track every trade, document market conditions, and most importantly, be patient. Remember, the best traders aren't the ones who trade the most, but the ones who trade the best setups.
That's really the perfect way to wrap up our discussion today. It's all about patience, preparation, and proper execution.
Absolutely right. And remember, everyone, successful breakout trading isn't about catching every move, it's about catching the right moves in the right way.
Multiple time frame analysis.
Trading without preparation is like trying to navigate through the Amazon rainforest with nothing but a pocket compass. You might get lucky, but the odds are stacked against you. Today, we're exploring how the most successful traders approach their craft, and it's probably not what you'd expect.
You know what's fascinating about that analogy? Most people think trading is all about quick reflexes and gut instincts, but it's really more like being a detective piecing together clues.
Let me break down why that detective work is so crucial. We're looking at how professional traders analyze the British pound versus US dollar, or GBP/USD, and it starts with something called multiple time frame analysis. Think of it like examining a crime scene from different distances.
That's such an interesting approach. So you're telling me successful traders don't just look at one chart and start making decisions?
Well, here's what's really fascinating. They start with the weekly chart, which is like viewing the city from a helicopter. In our example, GBP/USD had just broken out of a 2-month trading range. And here's the key detail many miss. It then spent 2 weeks in another tight range, which historically signals a big move coming.
Hmm, that reminds me of pressure building up in a pressure cooker. The longer it stays contained, the more explosive the eventual release might be.
That's exactly right. And here's where it gets really interesting. When drawing support and resistance levels on these weekly charts, many traders make the mistake of plotting lines thousands of pips away from the current price. But think about it. What's the likelihood of hitting those levels in a typical trading week?
So if we're focusing on the more immediate levels, what exactly should traders be looking for on that weekly chart?
Well, let me paint the picture. You want to identify 3 key things: the general market direction over recent weeks, whether last week was trending or ranging, and most importantly, where the major support and resistance levels are within a reasonable range of current prices.
You know what's particularly interesting about this approach? It's like having multiple layers of confirmation before making any decisions.
Right. And when we zoom into the daily chart, that's where things get even more detailed. It's like switching from that helicopter view to street level. We're looking for specific patterns, recent price action, and upcoming economic events that could impact our trading decisions.
Speaking of economic events, I've noticed how markets often behave differently around major announcements. How does that factor into the preparation?
Let me share something crucial about that. Successful traders actually mark these economic events on their charts and adjust their trading plans accordingly. For instance, if there's a major interest rate decision coming up, you might want to be more cautious about taking positions right before the announcement.
That makes so much sense, and it really shows how trading is more about preparation than reaction.
And here's where it gets really practical. We move down to what's called the execution chart, typically an hourly time frame for many traders. This is where you're marking out specific entry and exit points, almost like creating a battle plan.
You know what this whole process reminds me of? It's like how chess grandmasters think several moves ahead, always having multiple scenarios planned out.
That's a brilliant comparison. And let me add something important. Just like in chess, you need to be prepared for your opponent's moves. In trading, that means having both bullish and bearish scenarios mapped out before the market opens.
Well, that certainly explains why weekend preparation is so crucial. You have time to think clearly without the pressure of live market movements.
Exactly, and here's something fascinating from our example. After all this preparation, the market actually followed one of the planned scenarios almost perfectly. But here's the key thing. It's not about predicting the future, it's about being prepared for different possibilities.
That really challenges the common perception that successful trading is all about making quick decisions in the moment.
Let me share something counterintuitive about that. The best traders often spend more time preparing than actually trading. It's like the old carpenters saying, measure twice, cut once.
That's such a powerful insight about the importance of preparation over action.
And here's what ties it all together. This systematic approach to preparation actually helps remove emotional decision making from trading. When you have a clear plan, you're less likely to make impulsive moves based on fear or greed.
You know what's really striking about this whole discussion? It's completely changed my understanding of what professional trading actually looks like.
Well, let me leave everyone with this final thought. Successful trading isn't about having a crystal ball or making split second decisions. It's about thorough preparation, understanding market context, and having clear plans for different scenarios. That's what separates the professionals